Welcome, and thank you for joining me for this weekly episode of the Market Whispers podcast. I am your host, Beachman, and I am super excited to have you here today. Today is Friday, May 17th. Now, right off the bat, I must clarify that I'm not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, from the active chat line during market hours, and from this podcast. Most recently, in fact, this week, I wrote to my paid subscribers about an unusual cloud stock that I initiated a position in. I've been keeping an eye on this stock for about 9 to 12 months, tracking their business performance and slowly building up my conviction level in the company. And now that the stock has pulled back into more reasonable valuations, I decided to jump in by initiating a position in that stock this week. So please consider becoming a paid subscriber. Tell your friends and family. I'd love to have them and you join the growing Beachman community. And oh, by the way, a couple of other PSAs this week. So this podcast is also available in YouTube format. If you go to YouTube and search for Invest with Beachman, you should be able to find my channel up there. And then you'll find this episode about 12 to 24 hours after I post the episode on Substack. You can also listen to this podcast on your favorite podcast app. If you like to listen to podcasts on Apple or on Spotify, if you go to the Substack page for this episode and follow the instructions there, you should be able to start listening to my podcast on your favorite podcast app. In fact, once you connect my podcast from Substack to your favorite podcast app, then it will remain in your queue on that app and it'll alert you about any new episodes going forward. The other PSA I wanted to give you was the fact that Substack has now improved the transcription features for these podcasts. Some readers were frustrated about the lack of a transcript, and for several weeks I was providing my own transcript for the podcast, but then I wasn't able to do that because Substack put in some limitations on my ability to do that. But now Substack is auto-generating the transcript, and it's allowing readers and listeners to read the transcript on a full page on the episode page on my website for that episode. So now this works on the desktop website. It doesn't yet work on the mobile app, and that's probably coming soon. So anyway, those two PSAs I wanted to share with you this week. Now on to the meat of this episode. Well, as of today's close, markets were higher for the day, for the week, and for the month. Just this week, in fact, the Dow Jones added 1.24%, Nasdaq gained about 2.11%, the S&P 500 gained about 1.5%, and even the small cap index, the Russell 2000, gained about 1.74% for the week. The tech stocks were the strongest sector for the week. And on the weaker side, consumer discretionary and industrial stocks were the weakest during this week. So far this year, it has been a fabulous year for markets this week. Year to date, the S&P 500 has logged a gain of about 11.18%. The Nasdaq has gained similarly about 11.16% for the year. The Dow Jones took a little while to get going, but over this past month, it has really caught up. And the Dow Jones has gained over 6.14% for the year. And the Russell 2000 small cap stocks have logged a gain of about 4.5% so far this year, even in the face of higher long-term rates. That's pretty impressive. The US stock market now represents about 46.7% of the world's total stock market cap. That is near a record high, and that's a 4.5% increase year over year. We are now in the second year of a bull market. So this bull market started in 2023. In fact, some could you could argue that the bull market started in the late couple months of 2022, so around November, December 22. But now we're in the second year of this bull market in 2024. This run, as I said, started in 2023 or late 2022. And looking at data going back to as far as 1949, typically the second year of bull markets like this return about 12.1% on average. And so far, the S&P 500 has gained about 11%. So we're closing in on that record gain of about an average of 12% in the second year of such a bull run. The S&P 500 continues to hit new all-time highs. Even the Dow Jones hit an all-time high of 40,000 points this week. In April, we got a slight pullback. We didn't get a correction. We just kind of got a pullback. Officially, a correction is a drop of about 10%. But in April, we got a pullback in the S&P 500 of about less than 6% before markets turned back higher into the end of this week. Stocks this week turned bullish following the April CPI inflation report. We'll talk about that report in a few minutes. But investors started becoming more hopeful after that report that inflation is easing and that the Fed is more likely to cut rates sooner. The Dow Jones hit an all-time high, like I said, of over 40,000 points this week. That's never happened ever in the history of the Dow. And some investors are even calling for the Dow to hit about 60,000 in the next few years. What's remarkable and what's very positively surprising is the fact that all of these all-time high milestones are being hit even though we have short-term interest rates that are very high, above 5%, and long-term interest rates that are also at historical highs. Almost everything, pretty much everything is going up. Established Dow Jones stocks are going up. Faster growing tech stocks are growing up. Bitcoin and other cryptocurrencies are staying high and elevated. Even gold and precious metals are going up. The market is now in the mindset of good news is good news. And oh, by the way, bad news is also good news. That's the mindset that's floating around in the investor community today. Bad news is also good news for the bond markets, by the way. So stocks are up, crypto's up, metals, commodities are up, and even bonds are looking healthy because good news is good news and bad news is also good news. Now, why is bad news good news? Well, bad news is good news because if we get bad macroeconomic reports, that is more likely to push the Feds closer to cutting interest rates sooner rather than later. If interest rates get cut, like we've learned in this podcast before, as interest rates go down, the value of bonds go up. And so interest rates getting cut are bullish for both stocks and bonds. Now, on a price per earnings basis, right, if we try to look at whether markets are overvalued or undervalued, on a PE basis, the S&P 500 is at 20.8, a PE of 20.8. The historical average for the SP 500 is 18. So one could argue that the S&P 500 is about 10% more valued or 10% overvalued than its historical average. Mid-caps don't look overvalued at all. They sport a PE of 16.4 points right now. And small caps are not overvalued at all. Their PE, the PE for small caps, is 15.7. So all in all, markets believe that inflation continues to trend lower. It's moderating in the right direction. The economy is growing, as we've seen with the recent GDP report numbers. And therefore, markets believe that they could climb higher leading into the summer. Now let's talk about the macro reports we got this week that has led to this more bullish market mood. Well, the most important report we got this week was the retail CPI inflation report for the month of April. In the month of April, retail inflation rose 3.4% year over year. Markets were expecting a retail inflation increase of 3.4%. So they got exactly that reading in the actual report. In the prior month, in the month of March, inflation had risen by 3.5% year over year. So this was a better than expected report, and this was a drop in inflation as compared to the previous month. If we exclude food and energy and we just look at core CPI grew by 3.6% year over year. This was in line with what Wall Street was expecting, and this was lower than the previous month's 3.8% reading. So core CPI dropped. So all in all, this was a better report, and this better report followed 3 consecutive months of higher than expected CPI numbers. So we got 3 months, January, February, and March, of hotter than expected CPI numbers. And then in April, we got a better or a cooler CPI number. And this is one of the key reasons why markets got bullish. If we look at some of the underlying categories in the report, food and automobiles are no longer rising in price apparently. Monthly food inflation has been 0% for the past few months. Rents are still high but cooling, and kind of cooling slowly though. Auto insurance, that's still crazy high. Auto insurance costs were up 22.6% year over year, and gas prices seem to be creeping up again. So inflation eased slightly in April, providing a bit of relief for consumers, while still holding above levels that would suggest that a cut in interest rates is imminent. So perhaps the Feds would consider an interest rate cut sometime this year, maybe in the second half of the year, as I'm expecting. The other inflation report we got this week was the wholesale PPI inflation report. Now, wholesale prices jumped more than expected in April. The PPI price index is a measure of what producers receive for the goods they produce and that they sell to businesses. So the headline PPI inflation rose 2.17% year over year. In March, it was 1.83%. So this was hotter than the previous month. Core PPI rose 2.37% year over year. Again, this was hotter than the previous month's reading of 2.11%. So the PPI readings were hotter in April than the March readings. And even if progress on PPI inflation is stalling, it still looks like it's in line with pre-pandemic levels. So that is some cause for comfort as we look at these wholesale PPI inflation numbers. It's at reasonable enough levels to achieve the Fed's 2% target by the end of this year. As per Goldman Sachs, based on the details in both the CPI and the PPI reports we got this week, Goldman Sachs expects the Fed to cut interest rates by 25 basis points in July and proceed with cuts at a quarterly pace thereafter. So this kind of lines up with what I'm thinking as well, that I think we'll get our first interest rate cut of 0.25% in July, and then we'll get another cut probably in September, and then possibly another one in the December-January timeframe. We also got this week the April NFIB index report. This is the small business optimism or the small business conditions report for the month of April. Small business optimism was up in April, surprisingly. It went up to 89.7 points. Markets were expecting a reading of 88.2 points. So this was slightly higher than what markets were expecting. And certainly it was higher than the 88.5 points that we got in the month of March. So as we looked at why were small businesses a little bit more optimistic in April as compared to March, what we found was that hiring plans have ticked up among the small business community. Credit conditions have worsened a little bit, but not that much. The percentage of businesses saying that it is a good time to expand remains unchanged. So they're not expanding their growth or their operations. They're saying they're keeping it steady to what they had in the previous month. The percentage of small businesses expecting a better economy ticked down slightly. So again, that was kind of flat. And expected credit conditions for small businesses worsened a bit in April, although it hasn't gone back to the worst point in the previous business cycle. So generally speaking, small businesses are a little bit more optimistic as compared to March, but for the most part, they are holding their growth plans steady or flat as compared to the beginning of the year. The other macro report that we received that was important to note was we got the first reading for the month of May from the University of Michigan Index of Consumer Sentiment. Now, the Consumer Sentiment Report is a widely followed macroeconomic report. So it is useful for us to get a gauge of what consumers are thinking. So consumer sentiment for the month of May fell to 67.4 points. This was much lower than the expected 76.5 points that Wall Street was expecting. So that was quite a drop. Analysts were expecting 76.5 points, but the reading came in well below at 67.4 points. This significant drop in the consumer sentiment index was the lowest that it has recorded in the last 6 months. And consumers are primarily concerned about inflation and unemployment. This report highlighted a rise in inflation expectations for 2025. Consumers are expecting inflation next year to increase at about 3.5% year over year. 49% of Americans think it is a good time to find a high quality job, and this is lower. This is about 6% lower than the previous time this was measured in January, and this is the lowest since April of 2021. We also got a look at this week at the state of the federal deficit and the federal debt levels. The federal deficit has narrowed to about $1.63 trillion over the past 12 months through the month of April. However, over the same period, the US Treasury had to raise about $2.63 trillion by issuing marketable securities in the form of treasuries or long-term bonds. Now that is now a record total of $26.9 trillion in bonds that the US Treasury has issued so far over the last 12 months. So think about this, right? Let's step back and think about this. The deficit is only $1.63 trillion, but the US Treasury issued more than $1 trillion more than what the deficit was in terms of marketable securities and treasuries. So the Treasury had to borrow more than expected. The Treasury had to borrow more than the deficit because it needed to replenish its checking account at the US Feds. The US Treasury's checking account was down to almost zero last year in June. And so it has continued to try to replenish this checking account at the Fed through the issuance of Treasury bonds. The fastest growing federal government spend category so far is the net interest that the US Treasury is paying on all this debt that it has issued. This interest that it is paying on the debt on the US Treasuries that it has issued, this interest now totals over $810 billion over a 12-month period. This interest expense will soon exceed any spending that the US government does on defense or any other US government program. This interest expense is expected to reach $1 trillion on an annual basis by the end of this year. So unless there's some change in the amount of treasuries that the US Treasury is issuing, the interest that we pay on this outstanding debt is going to hit $1 trillion per year. At this time, so far, if we keep up with this trend, the US national debt will soon head towards a total of $40 trillion. Now, at the recent Berkshire Hathaway 2024 annual shareholder meeting, that meeting I believe took place last week, CEO Warren Buffett came up with a unique suggestion for fixing this debt situation in the US economy. This is what CEO Warren Buffett said. He said that if we send in a check like we did last year, we as in Berkshire Hathaway, the company. So if Berkshire Hathaway send in a check like they did last year, they sent in over $5 billion to the US federal government in terms of taxes that the company owed to the government. So if we continue to send in that $5 billion check on an annual basis, and if 800 other companies do the same thing, as in pay their fair share of taxes that they owe the US government, then no other person in the US would have to pay a dime of federal taxes ever, whether it is income tax or social security taxes or estate taxes. So Warren Buffett's suggestion is actually an interesting way to pay off the US national debt within a decade. If the top 800 US companies paid a minimum of $5 billion annually to the federal government, that equates to $4 trillion per year. And so, in about 10 years, that $40 trillion US national debt would be completely paid off. So that was kind of interesting. And if we step back and look at all of the major macro updates we received this week, if we look underneath the hood, I believe that there was something for everyone. If you are a bull or a bear, or if you're somewhere in the middle, I think you found something in these macro reports to continue to validate your point of view or your thesis. Inflation is trending lower, but and there are certain hot categories that are improving, that are trending lower. But there are also certain hot categories in the inflation report that are still elevated and give the bears some comfort in terms of their thesis that markets could go lower. Last month's data was not as bad as feared in some categories, but it was higher than feared in other categories. So markets continue to trade now in a regime where good news is good news and bad news is good news. Markets breathed a sigh of relief this week and they continued to move higher. The other reason markets were bullish were, I think, the fact that we didn't get any bad Q1 earnings report this week. The bulk of the Q1 earnings season is done. We just got a few important reports and most of them were better than expected. The biggest earnings report we got this week, I believe, was Walmart. Walmart shares surged up 7% after they reported their Q1 earnings with higher than expected revenues and stronger than expected earnings. Not only that, they also raised their guidance for the Q2 of 2024. So that helped markets continue to stay in a bullish mode. Now, next week, we have NVIDIA's earnings coming up on Wednesday, the 22nd of May. That's going to be a major earnings report that everybody is going to be watching. NVIDIA is the last mega cap tech stock that is left to report on how it did in its Q1 of 2024. So that report coming up on Wednesday, the 22nd of May, is going to be a major market turning point, either up or down, depending on what we hear in the report. Now, to be fair, analysts are expecting NVIDIA to deliver a strong Q1 earnings report. And we believe that markets will move higher unless there's something in that report that completely takes us by surprise. Now, why do markets think that NVIDIA is going to give us a good report? Well, recently, TSMC, or Taiwan Semiconductor, which is the world's leading semiconductor chip manufacturer, and NVIDIA produces all their chips at TSMC's foundries. So recently, TSMC reported on their order pipeline, and they reported that their order pipeline for GPUs and CPUs and data center chips is 60% higher year over year. All of their capacity for 2024 and for most of 25 is already spoken for. And markets believe that this bodes well for NVIDIA's earnings report next week. AI continues to be a major tailwind for revenues and earnings growth for many of the S&P 500 companies, not just for tech companies. Yeah, you've got tech companies that are producing these semiconductor chips and producing software solutions based on AI. But you also have other companies that are trying to use AI in their operations and are starting to see early results in how they can improve their productivity and make their operations more efficient. 41% of S&P 500 companies mentioned the word AI in their earnings call in Q1. This is up from 37% in the Q3 of last year. So many more companies are actively looking at AI as a means to improve not only their revenues but also their profits. Only 44% of companies mentioned the word inflation on earnings calls in Q1. This is the lowest number of S&P 500 companies citing inflation on earnings calls, going back all the way to Q2 of 2021, 3 years ago. Wow, time flies, right? AI is changing how data centers are built. It is changing how business applications are being programmed. It is changing how our phones and our computers and our cars will work in the future. And it is changing how we interact with the world. The AI has the potential to change our lives if we are a student, a worker, an office professional, a teacher, a parent, or even a homemaker. Governments around the world are waking up to the reality that AI has or will have profound implications to the prosperity of their economies. NVIDIA themselves have talked about the fact that their AI solutions are being bought not just by companies or by hyperscalers or by data center providers. NVIDIA has talked about the fact that their AI solutions are also starting to be bought by governments around the world. These governments are realizing that semiconductors are increasingly becoming an important product that their economies are going to depend on. Now, the US passed the multi-billion-dollar CHIPS Act recently to try to bring more semiconductor manufacturing back to the US shores as soon as possible. The US used to be one of the world's leading semiconductor manufacturers, but we lost that edge. We lost the bulk of that semiconductor manufacturing capacity to countries like Taiwan. Taiwan is now the world's leading semiconductor manufacturer. Now, this CHIPS Act that the US passed, the total bill is close to about $380 billion. Now, within that, about $39 billion has been earmarked in grants for semiconductor manufacturers to come back to the US to start setting up their manufacturing shops in the US. And recently we found out that most of these grants or subsidies have been rewarded to certain companies. Intel got $8.5 billion in grants to set up new manufacturing facilities in the US. Taiwan Semiconductor got $6.6 billion. Samsung got $6.4 billion. And Micron got $6.1 billion. So these are 4 examples of companies that got subsidies or grants from the US government to set up, and they've all started actively setting up new semiconductor manufacturing facilities in the United States. So about 70% of this $39 billion of grants have already been allocated by the CHIPS Act, and there's still about $6 billion left in the pot to give out. Now, giving out this money, that's the easy part, right? Passing the law was easy, allocating the funds was easy, issuing the grants was easy. But now comes the hard part. These companies have to build and set up these foundries. Once they set up the factories, they have to install the very detailed, intricate, high-tech machinery that goes into manufacturing these semiconductors. Once that machinery has been installed, they have to start producing semiconductors. They have to test whether their production lines are actually producing high-quality, ready-to-use semiconductors. They have to quality check their manufacturing processes and outputs, and they have to get ready to start producing high-quality, ready-to-use semiconductors in bulk, in production volume levels. So that is going to take some time. So we're in the early innings. As Morris Chang, the CEO of Taiwan Semiconductor, said, this is just the end of the beginning. The Semiconductor Industry Association forecasts that the US will eventually capture about 28% of the semiconductor manufacturing market by the year 2032. We're in 2024 right now. So it'll take 8 years for the US to get to about 28% of market share in this industry. And at that time, that will make it the second largest producer of critical semiconductor chips after Taiwan. Taiwan is the home to TSMC, the world's leading supplier of chips. 90% of the world's advanced chips are produced in Taiwan. Now, Taiwan faces a major geopolitical threat from China. China is just about 100 miles across a narrow marine strait, 100 miles across a narrow strip of sea. China is right there across the sea, and it has been threatening to invade that country, to invade Taiwan. China themselves are on track to spend about $142 billion with over 200 semiconductor companies in their country. So China is not sitting back and saying, hey, we're going to invade Taiwan and take over the semiconductor industry. They are investing money into their own local semiconductor firms. About 200 semiconductor companies in China are due to get about $142 billion in incentives. China now has more semiconductor plants under construction than anywhere else in the world. Now, personally, I myself believe in this AI revolution. I myself believe in the fact that these semiconductor companies are going to generate billions of dollars of revenues and billions of dollars of profits as well. I currently have an overweight allocation in my portfolio to semiconductors. I love investing in tech companies, and over the past 2 years, I have been focusing a lot of my attention on semiconductor companies. As AI started taking off with the launch of ChatGPT, I pivoted my focus primarily to AI companies within my portfolio. Now, the semiconductor industry is notoriously cyclical, right? It doesn't work all the time as an investor to just invest in semiconductor companies, because this industry is notoriously cyclical. As per Bank of Research's Global Research Division, the past decade has experienced three notable semiconductor up and down cycles. So just in the space of 10 years, we have had three notable semiconductor correction cycles. On average, the new semiconductor growth cycle lasts about 2.5 years. On average, that's the average for the semiconductor growth cycle. So that suggests that we're actually still in the early innings of the AI and data center fueled semiconductor investment growth cycle. And this is exactly why I have taken an overweight position in semiconductors and AI stocks right now. If history is any guide, if Bank of America's research is accurate, this would mean that the current semiconductor growth cycle will last through the middle of 2026 before the next correction starts happening. So this is the timeline we have in front of us as investors if we're interested in investing in semiconductor companies. If you look at research from Goldman Sachs estimates that the hyperscaler cloud service providers, companies like Microsoft and Google and Amazon and Meta, they are all expected to increase their CapEx spending in 24 and 25 with a combined CapEx spending potential to reach a staggering $200 billion of CapEx spending per year in the year 2025. Now, what does this mean for semiconductor companies? Well, most of this CapEx spending is used to buy AI GPUs and data center semiconductors. And that is why this is relevant to any investor that's investing in semiconductors and in the AI trend. So in 2024, these hyperscalers, these cloud service providers, have announced plans to spend a total of $180 billion in CapEx this year. $180 billion this year in 24, and that will go up by another 10% to $200 billion of CapEx spend in 2025. So this is another reason why I'm hyper bullish on semis. This is a reason why I'm overweight in semiconductors or semis. This is why I'm closely tracking the developments in this industry segment, especially with a lens that's focused on AI semiconductors. Now, as we move through the month of May, as we discussed earlier, markets are in a bullish mood and setting new all-time highs. So while the bulls are happy because markets are going up, the bears are also yapping and whining about their wall of worry because they continue to see signals within the macro reports that tell them that they should sell in May and go away. So sell in May and go away is a popular saying that Wall Street has adopted over the years. Sell in May. This is a popular market trader saying. One thing is that it rhymes. The second thing is it's predicated on the thinking that markets tend to do very little during the summer vacation time. Analysts at Bank of America are telling their investors in a recent note not to sell in May and go away because statistical data has shown that during presidential election years, like we have one this year, 2024, statistical data is showing that during presidential election years, we tend to have massive summer rallies. Now, Richard Excel, he writes a really good Substack called Stay Vigilant. I read his work every weekend when he publishes his latest read on the markets. Now, Richard Excel told us that this old adage of sell in May and go away actually started in London. And it actually started with the saying, sell in May and go away and come back on St. Leger's Day, which is September 15th. Now, the idea here, like I mentioned before, is that the summer months typically show a slowdown in markets. We're past the point of peak spending from the holidays, from the Christmas season, from Valentine's Day, etc. Bonuses have been paid out or sometimes not paid out, and these bonuses have been spent or invested, and there are just no catalyst for several months during the summer months. But looking at data going all the way back to 1928, the Bank of America analysts that I mentioned earlier, they have shown that June to August is the second strongest 3-month period for the S&P 500, with the S&P 500 being up 65% of that time with an average return of 3.2%. So when they look at historical data going all the way back to 1928, these Bank of America analysts found that markets have returned an average of 3.2% during those 3 summer months. And during presidential years, during presidential election years, markets during those 3 months have actually given an average return of 7.3%. So double the historical average. Markets have performed twice as better in the summer months in a presidential election year when we look at historical data going all the way back to 1928. So that's almost 100 years of data. Now there's a very widely followed FinTwit trader called Markets and Mayhem, and he recently shared his point of view on this matter. And Markets and Mayhem says that the riskiest month in the calendar year is September, where markets are up only 55% of the time, and they've delivered an average return of negative 0.7%. So markets are actually weaker in September as compared to May. But the problem is nothing rhymes with September. That's why this phrase, sell in May and go away, has stuck around longer than it should. Just because nothing rhymes with September and Wall Street traders couldn't come up with a saying that would take a hold amongst their trading desks. And finally, let's end today's podcast by talking about cats. And most specifically, a very big cat called Roaring Kitty. Well, if you don't know who Roaring Kitty is, let me explain. Now, the Roaring Kitty online identity belongs to a gentleman called Keith Gill. Keith is a famous deep value investor, and he gained a very loyal following of millions of retail investors for his Reddit posts and YouTube live stream videos, where he continued to recommend GameStop, buying GameStop shares in 2020 and 2021. And through his Reddit posts and YouTube live stream videos, he collected a gathering of millions of retail investors who started buying into GameStop. And thus GameStop is that stock that rose over 5,000%. Now this week, more than 3 years after those heydays of meme stock trading, this week Keith Gill, aka Roaring Kitty, posted his first tweet in more than 3 years, over 1,200 days. He posted a very cryptic tweet. So this tweet got more than 26 million views because it was the first time he was posting something in over 1,200 days. And subsequently, the Roaring Kitty account, this Roaring Kitty Twitter account has subsequently released a series of at least 50 cryptic videos. Cryptic videos from movie scenes and memes and music videos, etc. These videos got millions of views, appearing to suggest that Roaring Kitty would soon share a new stock pick that his followers could invest in that could inspire another GameStop-like short squeeze. Now, these tweets seem to be all over the place in terms of themes or topics or subjects. Now, there was one video clip from the Furious 7 movie. There was another video clip from the song See You Again by Wiz Khalifa. There was a video with lyrics from Dog Days Are Over by Florence and the Machine. There was a scene from the TV show Peaky Blinders. Oh, by the way, that's a great show. If you haven't watched Peaky Blinders on Netflix, you should check it out. It's a fantastic show about the Irish mafia in I think it's the 1920s. So there was another scene from the TV show Peaky Blinders. There were also lyrics from the song Bang by AGR. And then one of the last tweets in this series was just the words, "Oh, now do I have your attention?" Right? So all this created a flutter among the meme stock trader communities on Reddit and other online discussion boards. I mean, this is all that they live and breathe day in and day out. And in a matter of 2 days, they all started piling back into meme stocks. GameStop's shares rose 179% just in the matter of 2 days. AMC, which is another meme stock, that rose 135% in the matter of 2 days. So in just the first 2 days of this week, these two stocks rose over 135 to 150%. Now, since then, these stocks have lost value. In the subsequent 2 days, they lost value. And as I looked at the last time I looked at them just today, I believe one of them is up and one of them is down. So essentially, all hell broke loose because of these tweets that Roaring Kitty started posting. All hell broke loose in the online meme trading community. They started piling into these stocks, which started moving significantly higher and lower just in the matter of days. This reminded us of that 2020-2021 meme stock trading frenzy. Although, in terms of volume and in terms of stock price movement, this was a much more muted up and down movement amongst these stocks. These meme stock traders feel that they are at war with Wall Street. They believe that Wall Street is shorting these stocks, and by piling into these stocks and moving them higher, they feel like they can get back at these massive hedge funds on Wall Street that are making money by shorting these stocks. Now, these stocks are not healthy companies in the least. They do not have healthy fundamentals. They're not doing well in terms of their revenues, of their sales. They're not doing well in terms of their earnings. Let's take AMC as an example. So AMC is a 1.62 billion market cap company. This is the largest movie theater company in the world, but it has consistently been unprofitable, and it has very, very high levels of debt that it still has to pay back. So it is diluting its shareholder value by issuing shares and taking on more debt as it tries to pay the debt that is coming due in the next month or the next year. And this sudden resurgence in their stock price, this offered the management of AMC a chance to address some of its debt load. So what did they do? They immediately issued a new stock offering into the market just this week. In I believe it was Tuesday or Wednesday. They sold over $250 million of their stock to the open market. All of those shares were immediately bought back, and AMC used that money to pay out or pay down some of the $1 billion in debt that is coming due in the next 12 months. The AMC still faces substantial debt, almost of about 2.96, almost $3 billion of debt is coming due in 2026. So this new sudden stock offering didn't solve all their problems, but it gave them an opportunity to at least solve a little bit of their outstanding debt problem. And this is the situation with all these companies: GameStop, Koss, Clover Health, BlackBerry, and even Beyond Meat. All of them are unhealthy, unprofitable companies that have lopsided balance sheets and don't have the sales and the cash flows that help them address or correct these balance sheets. So, what's the investor takeaway from all of this meme stock trading? Well, one, if you made money in 2021 via this kind of meme stock trading, then congratulations to you. But I would definitely suggest to be careful with your moves or making similar moves this time around. Be careful in terms of how much you allocate to these kind of trades, because this doesn't seem to be the same kind of ultra bullish meme stock trading environment as compared to 2020 and 2021. Now, certainly this is very much like gambling on very little information and on very poor fundamentals for these stocks and these companies that are getting traded. The other thing that I would make you aware of is the fact that Wall Street has by now, over the last 3 years, they have put in place systems and processes to closely monitor these online trading chat boards, to closely monitor the discussions and the chatter that's happening on these online trading discussion boards. Wall Street is listening, and based on what they're seeing and reading, their AI engines are picking up on signals as to what investors might be trying to do. And they are taking action to profit off of these kind of signals. They are likely to use these signals in their market trading and positioning. Finally, I would definitely recommend that you watch the movie Dumb Money. It tells us the story of what happened in 2021. It takes you into the then life of Keith Gill, or Roaring Kitty, to help you better understand what happened before he started doing this, what happened during this meme stock mania, and also what happened after this meme stock craze petered out. The movie is very entertaining. It is a dry subject like investing and short selling, but the way they made the movie, it's very interesting. The movie has an excellent cast. The acting and storytelling is very, very good. So I would definitely recommend watching the movie Dumb Money. So that's all I have for this episode of Market Whispers. What's coming up over the next few weeks? Well, we don't have any important macro reports coming up next week. Just a bunch of more US Fed member speeches. We do have the all-important NVIDIA Q1 earnings report, like I mentioned, that's coming on Wednesday, May 22nd. On Friday, May 24th, we'll get another read from the University of Michigan Consumer Sentiment Report. The initial reading we got last week, we'll get the second reading or the final reading for the month of May on Friday the 24th. On Monday, May 27th is Memorial Day in the US, so markets will be closed on Monday, May 27th. So this will be a long weekend that's coming up at the end of next week. And then on Thursday, May 30th, we will get the second reading on the US's Q1 GDP growth. If you remember, the first reading gave us a GDP growth of 1.6%, which was almost half of what Wall Street was expecting. Wall Street was expecting a 2.5% growth reading. We got only a 1.6% growth reading for Q1 in the US. So we'll get the second estimate on Thursday, May 30th. So that's all I have for this episode of the Market Whispers podcast. Do drop me a comment or question anytime. I always love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest: for life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.